Hi, good morning, everybody. As we're trying this again, it's fantastic to be with you this morning. It's my absolute pleasure. I'm the Chief Sustainability Officer for the Johannesburg Stock Exchange, and my name is Shameela Soobramoney. My background, very briefly, is predominantly in corporate strategy and in finance, and alongside that, have worked with developing the sustainability narrative, as I've seen sustainability grow in terms of one of the key trends in relation to strategy over the last number of years, and then included that fully within the strategy portfolio as the JSE, as this debate and the intersections of strategy and sustainability have grown over time. So my brief today was to speak to you about why sustainability matters, and often we have this view, or with this shorthand for sustainability that we often refer to as ESG, and that is the acronym for environmental, social, and governance factors. Now, predominantly, the need to even have something like this codified, which we hope in time is going to change, and that we will no longer refer to ESG or sustainability as something separate, and that we will see this incorporated fundamentally into how we think, how we act, how we report, and how we measure. For now, as this is still fairly new to most of us, it needs to be separately considered. At least that is my view, that in time this will be absorbed into just how we do business and will be a fundamental part of strategy and the way in which we think about how we create value and how we destroy value. So if we look back very briefly in the movement in relation to sustainability and where this really started, we go way back into the 80s, perhaps even before that. But really when we started seeing the crystallized notions of sustainability goes from the 80s into the early 90s. And this was considering that the way in which we developed has resulted in a number of inequalities, in a number of issues that we very briefly considered to be the externalization of internality. So it said we do business in a certain way, and that there are impacts that this actually results in, and that we haven't often quantified that because the way we measure our accounting systems and the like have typically been premised on looking only at financial issues and only things that we know how to measure from the typical ways in which we've been taught to measure. So things like what the impact is on the environment and how do you quantify that when you emit a certain amount, and that is actually now starting to encroach on the ability of the Earth's adaptive capacity, for example. So how much should you be doing? And there are limits. So the notion of limits is the first one that we often have not worked along in relation to the planetary boundaries and the like. So those are some of the concepts that are really considered within sustainability, and the fact that in the way in which we've pursued profit in some of the capitalist models in their current state have also resulted in a number of social inequalities, for example, and that these need to be factored in. We only need to consider the situation that we're in right now in relation to COVID, when we've seen the amount of money that is needed for stimulus and the like. And what is that really? More and more it's understood that the instance of diseases and pandemics like COVID are directly related to nature, and the fact that we have encroached into nature to such an extent that these things have now grown in prevalence and will continue to grow, and this poses a risk. And we've seen how that risk has played out, and we certainly can quantify what the impacts of those have been, and that we will continue to be quantifying that for time to come. So immediately we have a case in point of how we can see that the manner in which we've done things often has resulted in these consequences that we're unable to see for coming immediately, or that we're not trained to be able to see. So if we look at that, that would be some of the kinds of issues that we look at. The slide in front of you is a slide that was effectively what I thought was such a poignant way of encapsulating this. This is a campaign that was run by the Financial Times towards the end of last year by the then editor Lionel Barber. And if you look at that page is Capitalism, Time for a Reset. And he's effectively saying that this is where we are right now. This model hasn't worked the way that we hoped that it would, and that what it's doing, in fact, is creating huge inequalities in many ways, and that we need to fundamentally rethink how we do it. Of course, there have been huge benefits to economic growth, to development, and to inclusion of many people. And so that is a given in relation to what we've done. But there's certainly ways to do it better to try and deal with the kind of inequalities that we have seen up to now. So if we look at that, I mean, he's effectively saying that to look at this, he's basically looked and said, well, what can we do about capitalism? How should we be thinking about it? And saying, let's rethink about it. If I look at that, I've also got quotes from a few others that you probably will be familiar with that will fall in broader work of finance and the financial sector. BlackRock CEO Larry Fink, many of you might know because he's often quoted because of BlackRock's rather strong stance in relation to the need to consider sustainability and a rethink about how we do it. So if we leave those, and I'll leave these quotes for you to read, but I also want to just pause and look very quickly at the one circled in red, which relate to climate change in specific. Climate change is one of those that we consider in the ESG spectrum, and certainly is probably one of the most dominant, and no doubt you must have been living under a rock if you haven't already, at least encountered in some fora climate change, the impacts thereof, and the concerns about the risks that it poses going forward. The reason I'm picking on this one is because it's perhaps one of those that's the most quantifiable, because a lot of attention has been spent into modeling and understanding what those impacts might be, and therefore how we can factor that into business. One of the biggest challenges that we do see often is that people say, well, what is this ESG thing? How do I measure it? Because if I can't measure it, it doesn't matter to me, because then I can't fit it into my traditional accounting models. As we know, that is changing, but climate change is one of those, I think, that's perhaps a little bit easier because there's been a lot more work done in very tangible terms. We're seeing global pricing, for example, in relation to carbon and carbon emissions, and the moment one can start pricing, it becomes easier to understand the financial implications of some of these issues. So on that slide, we're talking about a few things then. We're talking about BlackRock, we're talking about what BlackRock has said in that regard, and the next slide, which you see in front of you, then takes forward this notion that I've just mentioned of the issue of risk. This is from the World Economic Forum annual report that they put out at the beginning of the year, and this talks to what the World Economic Forum has looking at being the key long-term risks, and it looks at risks in relation to likelihood and in relation to impact. And if you look at that, and this is the language that most of us understand in business, the language of risk and how we rank risks and how we look at likelihood and impact is something that we're familiar with. And if this is now produced by the World Economic Forum and not some loony left environmentalist group or whatever that might be, we can start to see that if we look on the spectrum here, on your right hand side of your screen, for example, you can see that the first 5 dots are green. Now, green depicts those risks that are considered or classified as being environmental in nature. Now, if the global risk report is telling you that the top 5 risks are actually in the spectrum of E, and that there's another one in that top 10 that is an S1, and sorry, I'm not being able to see these slides too clearly on my side, so I'm hoping you can read the risk, but you'll be able to see exactly which ones those are. So in that spectrum, I think probably 7 or 8 of the top 10 risks relate to E and S factors, and the remainder are interlinked in a way. So if we look at this and nothing else, and we only consider from a risk perspective, this should make us stand up and take notice as a business that these are matters that are going to be of consequence to us, and the way in which we understand and manage them is going to be critical to how we consider value creation and value destruction in the longer term. And we need to be able to understand how this impacts us. And this then goes into that realm again of your ESG or your sustainability thinking, which, like I said, if you consider this, should become part and parcel of how we do business and not a separate view. So that would be the risk perspective. Then there's another perspective to this, and I'm going to ask Gerhard to move on to the next slide, please. This is the performance perspective. So many of the cynics often say or consider that to invest in mitigating some of these risks, or in actually making their companies more resilient and making long-term investment, that they somehow are going to sacrifice returns. So investors might think, well, if I invest using an ESG lens or a sustainability lens, I'm going to sacrifice return, and that there's some kind of a trade-off. This is a recent stat and a very quick one that I wanted to share with you, and many of these are now available if you look at even just the recent press. This is the MSCI Emerging Market ESG Leaders Index versus the MSCI Emerging Market Benchmark Index. And what this is really showing you is the outperformance of the ESG Leaders Index for emerging markets over quite a long period of time. And this is really where those companies who are constituents of the Emerging Market ESG Leaders Index are those, as it says, who have scored a certain rate and above and consistently scored higher in relation to ESG. And those are the companies that make up that index. So you can see, even in an emerging market context, over a period of time, sustained outperformance of those companies. Now, if you read some of the literature on this, often this is attributed to the fact that those companies that make an explicit attempt to consider your environmental, social, and other issues alongside your purely traditional financial issues, generally, the fact that they consider that is considered a proxy for good governance and good management. And that ultimately in itself should also help with the long-term prospects of that company and its long-term financial performance. And so that is some of the way the narrative is tied together. I urge you to also look at a recent report by BlackRock, which is referenced at the bottom of that slide, where even during this period of distress, this period of global pandemic, and in times like this of uncertainty, consistently now we have track record and history to be able to see that those funds with a particular ESG bent and flavor that have been looked at for in relation to their performance in that regard, where those factors have been explicitly considered, have actually proven to be more resilient at times of uncertainty, at times like we've seen of the pandemic, post the financial crisis. So now we have certain data points that actually consistently prove each time that these stocks tend to be more resilient, those that perform better on the ESG scoring. So from a resilience perspective, those companies that are scoring higher on ESG, and that given that that is seen as a proxy for better management with those companies, it starts to make sense that one can expect that better managed companies are going to perform better and going to be more resilient. And the ESG lens is just helping us to prove that notion even more with the explicit consideration of ESG factors. I want to also then turn to the next slide, which talks to some of the trends that we've been tracking as the JSE before I go into what we're in exchange are doing. So if you look at a few of those trends that you can see up there, just please give me a second because I need to look at this. So if we're looking at those, this is very high level. I wanted to share with you the kinds of things that we're seeing coming through and that we're finding to be quite relevant as themes. So when you're considering sustainability, this is the kind of information that we as an exchange are finding to be relevant. So the first one is the greater focus on sustainability from all quarters, and this huge expectation for private sector to stand up and to show leadership. For those of you that follow the Edelman Trust Barometer, you will know that over a number of years, the barometer was scoring lower and lower and lower. And what this barometer looks at is the level of trust that civil society has in government, in the media, in NGOs, and in business. So if it looks at those factors, and the fact that it's been decreasing over time is of course very worrisome, because it says that society as large has lost its faith and its trust in these entities. Now, for the first time in a long time, we saw an uptick in that last year. And the biggest uptick was, in fact, in relation to society's trust in business. And if you double clicked on that a little bit, the expectation was that business leadership, i.e. CEOs, senior leadership, would step up and become those people that society could then start placing more trust in. So saying, business, this is your time to step up, show leadership, reorientate the way that you consider value, and the notions of shared value and those ideas are the ones that are coming to the fore. What value are you adding to society by your existence, and are you considering that society in which you operate with the understanding that businesses cannot prosper in a society that is failing? So this notion and this idea and this greater focus of sustainability, we're really seeing coming now from all quarters. Having been involved in the field for a number of years, I personally can attest to seeing that, particularly in the last 2 years, a huge uptick in interest in this area, in awareness, and as you would have seen even recently locally in the market, shareholder activism. All of these point to a more engaged civil society, and a civil society that is saying, we actually want business to take more action. So the second trend on that slide about private sector becoming more visible in a way is related to the first one. And in that regard, I'll speak about this a little bit later, but we've seen a few different things. Earlier this year or last year, we saw the roundtable commitments where we had a number of CEOs, predominantly in the USA, actually stepping up and saying, we are making a commitment to look differently at business and to consider the stakeholders at the core of what we do, and not just a shareholder capitalism point of view. This year at the World Economic Forum, the focus was stakeholders for a cohesive and sustainable world. And I urge you to look at all the repository of information at the web. It's really interesting to see what leaders have been saying, and actually, more importantly, what many of them have been doing. And so looking at that, the GISD Alliance was formed last year. It's the Global Investors for Sustainable Development Alliance, a number of players in the financial sector coming together to say, how can we use our collective power to start changing the system that we know has an entrenched and pervasive short-termism, and start looking to achieving things like the SDGs, scaling up financing, because the reality is not achieving those actually poses a risk to all of us. And the longer term cost of that is something, firstly, that's going to be hard to quantify and very difficult to model, because it is so very much intertwined and they're so systemic in nature. So let's step up and do something about this. The third trend, climate change and the associated systemic and financial risks are dominating the discourse. I've mentioned that already, but we need to also be aware when we're considering sustainability that sometimes this tends to crowd out other critical sustainability issues. And so we should keep our minds to the spectrum of what these issues are and deal with all of them to the best way that we can. The fourth trend about shareholders starting to ask more ESG questions and sustainability questions of companies. And here we've seen a few companies in the local market face resolutions, shareholder resolutions, and the indication, and that is just reflecting a global trend. So one can potentially expect more to come, and different kinds of resolutions to come. And this is really, again, talking about more awareness from actual shareholders, from civil society at large. And the millennial effect also is another one that we need to consider. You probably have heard of this before, but really this is the generation that's coming into effect, and that is really now taking over and is going to become that dominant generational cohort. They have a fundamentally different way of looking at the world, notwithstanding the selfie generation and the narcissistic tendencies sometimes that we know. The reality is that this is a generation that is thinking very differently about their own impact on society, on the world, and a greater consciousness of issues in relation to sustainability. How does this play out? Two ways predominantly that we can see. Number one is that they're the inheritors of intergenerational wealth. So when they're coming in coming with money often, maybe less so in developing countries like ours, but the fact is they are inheriting certain amounts of wealth, and they want to invest these in a way that they can see is doing good. So we're often seeing that they're prizing doing good over just doing well, as in typically measured in financial terms. So they want to know, I'm investing my money, but what good is it actually generating? So how does that affect us? These are the people that are going to become the investors in the companies in which we work for at this point in time. And if they're saying, we don't like what you're doing, the chances are you're going to have a shrinking investor base. The other one is that this is also the cohort that we want to employ in our companies. And if they're looking at you and saying, well, are you really a responsible citizen? What are you doing? And they're becoming more critical about whether we're greenwashing or SDG washing and talking a good talk, but not really doing those things like caring for our employees, caring for the environment, understanding our impacts better. And so once we consider their preferences, you can see that there's shifts and there's changes from different quarters. If we look at the next trend there on the buy side, looking for more investable products which are sustainably focused, we're seeing this. The needs are evolving globally. I mean, there's a huge shift in this. We're looking at assets under management that are following some kind of responsible investment strategy or the other, probably close to 40% now. It is a little bit difficult to track this number. In the last reliable statistics we have are in 2018, but the indications are that this is just growing and growing and growing. And so we're probably looking at around 40%, and that's quite a staggering number. Of course, there's a huge variance in relation to responsible investment strategies, but the fact that these things are being considered in the first place and being actively factored into investments is something to take note of. We're also looking at growing momentum for the alignment of standards, frameworks and definitions. This space and frameworks, standards and guidelines have largely been voluntary over years, and so of course has led to this proliferation of frameworks and the like, and what we often refer to as the alphabet soup of ESG. So the alignment of that is something that is critically important, and that is work that is being undertaken by things like the Corporate Reporting Dialogue and the like, who are looking at how do we streamline that, and that poses a lot of hope for people coming into the game to say, well, actually, it's going to become a little bit easier as we start seeing alignment of these standards, but it does not absolve us from applying our minds to these factors anyway and understanding how they impact our business and our value creation process and how we impact on these factors. And then, of course, the sudden uptick in local company interest in sustainability and wanting guidance and training. So I can personally attest to this, being at the stock exchange, where we're getting calls more and more often now asking for training. And in fact, we're launching our first broad-based ESG or sustainability training in July. And this is really in answer to the fact that many people are saying, we just want to understand, what does this mean? Who's watching? Why should we care? How is it playing out? And so we're actually going to do quite an in-depth training in that regard. And we've been asked to speak to boards. We've been asked to speak to board subcommittees, particularly social and ethics committees, to be able to explain why this matters, as people are trying to understand and trying to start factor this in and understand that it's critical to good governance. So Gert, I think if we can please move to the next slide. Then very quickly, I want to touch on the role of the stock exchange. So the stock exchange sees ourselves as being quite multifaceted. Essentially, as you would expect of an exchange, we see ourselves as a central player in the local economy with a global reach. And fundamentally, that value proposition as a market infrastructure is that need to ensure sustainable access to capital and fair access to deep, liquid and robust trading platforms. So you would expect that. You would want to ensure that there's a place in which stocks and shares can be traded and that your pension portfolio can be maintained and the like. So that fundamental purpose of the exchange, or what it does, fits in there. So on the top right hand side corner, you can see this little pie chart, and that talks to the three faces that we consider us wearing as the stock exchange. The first is us as the exchange itself, which is the platform for trading and capital raising, which is what I've just mentioned. The second one is the JSE, the listed company. So it's an entity like any other company, has a corporate form and a face. And the third one is the JSE, the regulator. So this, some of you might consider when you think of the JSE, you think of the issue regulation team and the team that looks at I guess setting standards for what needs to be disclosed and policing whether you released your financial results in time and whether you disclose the right information and has sanctions if you don't. That is the issue regulation part of the JSE, and that's one of the regulatory divisions. The other one is the surveillance, the market surveillance division, and that polices trading activity. So there are quite strong Chinese walls between the two regulatory divisions in the JSE and the rest of the JSE. So the regulatory divisions, of course, get their power from the Financial Markets Act as self-regulatory organization. So they perform those functions, and they're even separately managed in instances and have different governance structure to ensure independence from the rest of the business. So that is the three faces that the exchange wears. And we have to constantly strike this balance between running a stable business, just like any other company, and also our external sphere of influence. And it's important for us to note this, particularly in relation to this conversation on sustainability and what the exchange is doing to try to ensure that as a marketplace, these practices grow. So could we move on to the next slide, please? So very quickly, I mentioned earlier on the Sustainable Development Goals and the SDGs. We have looked at those and looked at which are the ones that we immediately think we have the greatest ability to make an impact on and to make inroads on, and these are listed here. So reduction of inequalities, driving responsible consumption and production, climate change, and partnerships for the goals. So these are the ones that we initially are working with, and of course there's a huge interrelatedness between these and many of the other goals because there are knock-on impacts on these. So the next slide, please. Then in relation to what the exchange does, so at the heart of what we do in relation to this consideration of sustainability, our work goes back to around 2002 with the understanding that sustainability issues, in fact, were front and center to that which our businesses face. If you look back at 2002, you look at the kind of companies that and industries and sectors that are represented on the JSE, which are still there by and large, immediately things like the mining sector comes to mind. Environmental impact, social challenges, as we know. So many of these issues that are considered ESG issues were actually front and center to those things, to how our companies were doing businesses and what they're facing in a daily manner. We were seeing the growing global interest and the need to do something to ensure that our market started factoring in these issues, was behaving in a way that was more transparent, and thereby hopefully in a better position to manage that value creation process and develop more resilient companies. So we had taken the carrot approach and not the stick approach, and wanted to create that enabling environment for better practices to grow and to flourish, and to understand that really sustainability is part of good governance. So it's a governance issue first and foremost. I've already mentioned the regulatory framework. So if we set ourselves out around these 4 areas and what we're calling our evolving hybrid approach to sustainability, and evolving because the nature of these issues is evolving, what we can do is evolving, and of course the global temperature on this is also changing and we need to keep up. So the first one says the regulatory framework, the top left corner, and also that we are one part of a broader regulatory infrastructure and ecosystem, or governance ecosystem. So there are many players in that space, and we work on the part that we can, and there are other players, would be the Companies Act, would be a number of other aspects that would play into governance generally. So there are certain mandatory requirements that we look at for disclosure, for example, and of course we've got the King Codes, apply and explain. So this is really about trying to push transparency, but more the integrated thinking approach, that this is not a tick box exercise where somebody says, give me all the factors, let me just see that I'm reporting on them. This is saying, are you fundamentally thinking about how these affect your business and looking at that at a strategic level and incorporating that into your business model and saying, well, maybe I need to shift that model, not that I just need to tick the box. So while there are certain things that are mandatory disclosures, what we're really trying to drive is the notion of integrated thinking, and that you're reporting in accordance with that integrated thinking, and that reporting is really at the tail end of actually changing practices. And so these are some of the mandatory requirements that we have. We may look at more going forward. It just depends on where we see the need to be and what it is that we are best placed to be able to do as the exchange in our own local regulatory context as well as the global context. Then on the right-hand side, you can see the tools and services that we offer. And this is really to say, how can we help then the reallocation of capital to be able to be reorientated towards more sustainable investment, or investment that is more in line with achieving sustainable development, the green economy, and reorientating money in that way. So the tools there, we've got the FTSE Responsible and the JSE Responsible Investment Index. That really then is an index, or a set of 2 indices, in fact, where the constituent companies are those who have scored a certain ESG rating and above. So there's a threshold on a rating scale of 0 to 5 of 2.9. If they score 2.9 and above, then they become constituents of a benchmark index, which can be used as a reference point for companies with a certain ESG score. And of course, the model that we use for assessment is with our research partner, which is FTSE Russell. And so that assessment process is done using only publicly available information in order to enhance this matter of transparency and equal access to information for all stakeholders. We would only engage one-on-one with companies. We only consider what they have put in the public domain, so there's equal access to all stakeholders, and then use that to formulate the ESG rating. And so that would be the one. There's a top 30 variant of that. And then we also have the underlying data. So the big benefit of partnering with an entity like FTSE means that we can now offer ESG data going back to 2014, 2015 on up to 300 indicators, and you'll be able to see that in historical view as well, and use that information to create bespoke strategies, momentum strategies, different strategies on investment, because you now have the underlying actual data that you can slap slice and dice and use whichever way you want. And so that data is available from the JSE, and a new offering is going to be the green revenues data, first of its kind, we believe, in the world, where we're going to start looking at the kinds of revenues that companies are generating that are in line with what we broadly consider to be the green economy, and therefore look at that as being, some of the actual value proposition that that company has in longer term, more resilient revenue line items. And so that would be the data offerings. And then at the bottom, you're looking at advocacy and engagement. And that really is saying, how can we advocate for more sustainability practices? We sit on a number of fora locally and globally to ensure that we both learn from and contribute to global discussions and local discussions in relation to sustainability, so that we stay relevant and that we are able to drive the market in that direction. The fact that we even have these assessments like the ESG ones done on the market is often considered very favorable by global investors, and who often see us as being actually world leading in that regard. And the fact that we don't have mandatory disclosures, but we still have fairly good disclosure in the market, is something that is again seen very favorably by global investors on the South African market. It's of course not all done. There's a huge way to go. And when we're talking about good disclosure, we are talking about the bigger companies, generally your sort of top 100 type companies. So there is still a lot to do, but the fact is that it is still far ahead of many emerging markets. And we hope that that is a trend that will continue as many markets are catching up very quickly. So on the engagement side, again, this is really about how can we do more to encourage more sustainability practices and understanding in the market. We annually have an ESG investor showcase, and that really brings together the investor community. You would have received invitations as SAICA members before to come and listen to what companies are doing, but also listen to what investors are considering. And we evolve that showcase every year to be more relevant and rooted in the issues that are now, and really try to make that a focal point for people to understand what is happening in practice on the ground, and hopefully get ideas and be inspired. And of course, a number of customized presentations and trainings and partnerships that we also run in relation to sustainability. And then finally, I just want to talk very quickly to one of the things that we've been very involved in fact, taken a step back from a lot of local sort of fora and things that we've been involved in purely from a capacity perspective, to focus on the Global Investors Alliance. Our CEO, Dr. Leila Puri, is co-chairing the alliance at a global level, and these 30 financial institutions coming together to see how they can further investment into the SDGs in a fundamentally different way and coming out with tangible outcomes. So if I look at that, Kat, the next slide, please. These, I think, is a very interesting and exciting view of, I think, the future to come in this space. The first one that's already been done, and this alliance was only began last year in October, is that we've already piloted a definition for sustainable development investing within the alliance members. And this is really answering to the fact that there's so many different definitions, different frameworks, but how do we measure this in a way that is actually impactful and directly aligned with the SDGs? And so the team has come up with a sustainable development investing definition and broad framework. It's quite short, but I think it's really, really exciting. It's being piloted. If you're interested at all in looking at something like this, please reach out to me. We're happy to share it. We're also finalizing a guidance note on investor preferences for COVID bonds. You would have seen that the issuances of COVID bonds globally is massive, and there is a lot more expected to come. And this is a huge opportunity to actually look at directing that stimulus and that money direct towards sustainable development and the longer term view. So the Alliance is saying that there are certain immediate needs that money obviously is used for, but even those can be aligned at a target level to the SDGs when we talk about impact. And so this note is trying to be almost like a cheat sheet to really help issuers to be able to quickly line that money up so that they don't have to have sort of red tape up front of needing to understand and can do that. That should come out within the next month. It will also be helpful to investors if they just kind of like, how should I be thinking about this? What questions should I be asking of issuers before I buy that, the debt or whatever, and be able to understand how this can be linked back to the SDGs. So I know that the money I'm investing is actually having a longer term impact as well, potentially, and answering to immediate needs. So it would answer to a few. Then in the longer term, we're also coming up with an investment typology, which is really saying that many of the investment, the sort of mandates that we have right now are quite narrow, and in fact, the kinds of instruments that we have and the risk tolerance is really not there at the level that can meet some of these needs for the SDGs and SDG investing. So what ways can we blend capital? What vehicles exist? Where are the good examples of this? And we're curating all of that information globally into what we're calling an investment typology that hopefully would be a quick reference guide to how one can do these things. The SDG Navigator is linked to the first one on the Sustainable Development Investing definition. And this is, again, a curation of a number of the different frameworks and measurement techniques and tools, and being able to see, well, what, just map these out. So it's not something that you need to get an expensive consultant to do, but how can we help people do this quickly and easily and be able to offer this as an offering to be able to quickly try to allow money to be allocated towards the SDGs. And then finally, another area we're looking at are matching platforms for SDG investing. So what are the types of themes that we're talking about here, and how can we bring together investable projects that we've looked at and tried to tweak around the way to make them more attractive to investors, and then put that on a platform that matches investors to those needs. And because this is actually an alliance of investors, they understand what other investors are looking for, and so are able to work together to try and overcome some of those hurdles that are relevant in the market today. So those are some of the things we're doing. And one of the other areas, of course, is currently engaging with the EU, understanding that the process of the EU Green Deal and EU taxonomies and the sustainable finance strategy is potentially going to become definitive for the world as a reference point. And so it's necessary to engage, to understand and see how one can influence or contribute to that process, given that it will become a reference point and hopefully give a more global voice to some of those considerations. So I'm going to stop there. And that is really some of the stuff that the JSE is doing, and why we consider sustainability to be important, and the role of the financial market. Thank you.